Good afternoon. Time to check in on the markets. A bit of a mixed picture when we look at the Asian session, with the Hang Seng Index down 2.3%. Chinese mainland markets, they were down 1.1%. Overnight, we did see strong U.S. earnings fueling gains for a second session. Earlier this morning, UK inflation coming in at 10.1% for September year on year, higher than expected, reaffirming the notion that inflation in the UK is robust and that the Bank of England will have to remain ultra hawkish. Locally, when we see news announcements, the one major news announcement that caught investors' attention: MTN withdrawing a takeover bid for Telcom. Telcom's share price plunging more than 20%. And we will get into that discussion a little bit later on with the market watcher to discuss what could have gone wrong here, perhaps. And also, let's look at how the share price has performed, down about 35% so far this year. We also had Standard Bank mentioning that higher client transactional and trading activity boosted earnings, and that share price up 5.9%. But to talk to us about the latest, we are joined by Gary Boyson from Rand Swiss. Gary, thank you so much for your time. MTN, the big one, before we even talk about JSE performance, withdrawing the takeover bid for Telcom. And it's quite interesting. The share now down about 23%, and so far for the year down 35%. What do you make of that news announcement? Was that expected?
Certainly it wasn't expected, otherwise we wouldn't see such a large share price move. I say that, but at the same time there was always going to be antitrust issues around this. So, if MTN was to take over Telcom, it would reduce the number of mobile networks that we have, to only 3. So this was always going to be very difficult to get through the Competition Commission. Now, in the announcement, they did highlight that it was through lack of exclusivity around the deal. So, if you've been following the story, obviously Rain almost made itself available to be taken over by Telcom. This seems to have muddied the water a little bit for MTN, and we're seeing the share price of Telcom obviously fall back on the back of that.
Speaking of that share price, we are actually going to put it on screen for the viewers, starting off with the 5-day chart for Telcom, just to give you some perspective when we talk about that move, almost 23 to 25% earlier this morning. And then we're going to be switching to a 6-month graph that just shows you the actual movement of that share price, at least since the beginning of the year up till now. So, I mean, now what? Is it a question where we then think the tie-up between Rain and Telcom would make sense? What has been your conviction, I suppose, in the past when you look at Telcom?
Well, I suppose if you look at Telcom, when Telcom was trading, just even sub 20 rand, it is a very good business. What Sipho Maseko has done over the last, let's say 8 years at Telcom, before leaving, was absolutely spectacular. It turned around a very inefficient business, and there are some very nice assets within Telcom. So, at that level, it was very cheap. Now, when you look at traditional merger arbitrage theory, what happens is, traders will essentially go and buy the stock that is being acquired, and they'll sell the company that's doing the acquiring. Now, when you get a deal announcement like this, revoked, obviously that trade immediately unwinds. So anyone that was buying into that ahead of the potential deal will now dump all of their shares, which is why you're seeing the share price hit as hard as it is today. If it continues to fall at some point, Telcom is still a very nice and very attractive business. Like, as I said, they've got some interesting assets underneath it. Obviously, with the government being a big anchor shareholder there as well, we do like the investment case, just not at current valuation. So, should we see the share price falling back a little bit more, it might become attractive and something that investors would want to pick up.
Speaking of, I took global equities for a bit, where they caught between, great U.S. earnings so far and also central bank hawkish rhetoric. Given that dynamic, as we're seeing with global equities slipping, how's the JSE holding up so far? And is that rally even, sustainable?
Well, if you look at the kind of companies, so we were right at the beginning of the US earnings season, so the kind of companies that we've had reporting, primarily are more value-orientated companies. So Netflix reporting last night was the first, almost growth company, although you can argue maybe Netflix is ex-growth as well. But the likes of Wells Fargo, JP Morgan, Goldman Sachs, all of these are the banks that traditionally, they are seen as value companies. They trade on lower multiples usually than the growth companies, and they've done very very, very well because this is a value-orientated market. When you have rising interest rates, people are less inclined to pay up for future earnings. So if you can go and put your money in the bank and get a decent return, there's no need to go into a company that's promising you future earnings somewhere down the road. You can just go and stick it there. So what happens is equity mandates specifically shift into more value type counters. One of the reasons that I think that you've seen the South African banks do well as well. So obviously you saw Standard Bank's numbers out today, rising interest rates obviously benefiting them, no doubt, but also attracting the interest of the market because one, they have a very good dividend yield, two, in terms of earnings they're not particularly expensive, and three, they give investors I suppose a shelter in the storm because of their very defensive positioning, being in a heavily regulated industry, and South African banks generally are very well capitalized.
We've just got about a minute left for our discussion. We had Netflix earnings showing that it is starting to do better than it was in the previous quarters. Does that then change your conviction on Netflix and its peers, or you still, there's a lot more you want to see?
Well, I think, again, it all comes down to the price that you pay for security. So, with Netflix, at some point, it does become attractive. From a top-down approach, so if you're looking at it just from a sector point of view, I think Netflix is going to struggle. You look at the competition that's picked up in the sector. You've got Amazon Prime, you've got Netflix, you've got Disney Plus, and the offering is just expanding and expanding. So their kind of unique selling point, which has really just driven that share price up over the last 5 years, might not be there. As you say, they had guided for about 1 million additional subscribers. They got 2.4, but a lot of those were coming out of Asia. Only about 100,000 subscribers coming from Canada and the US, which is their primary market. So I think they are a company that traditionally was a growth company, but they're almost going ex-growth at the moment. So I would be nervous.
Okay, well, on that note, that's where we're going to pause the conversation with Gary Boyson and continue to monitor U.S. earnings. That is it from me. We're going to take a quick break, and when we come back, we'll have more news for you.